All right, guys. So today I want to upload a little bit of a nuanced video talking about the characteristics of price behavior as they approach a level of interest. And it's important to look at the way price approaches a certain level. And maybe you've identified a level that you want to trade into. Right now, I'm looking at the summer consolidation on Bitcoin from 2021. Maybe you identified this level right here, this area you want to trade into, that 4,500 level. And then so price runs up. And this is a really good indication that, when price moves this impulsively into your level, that's a really good sign. You want to take that type of trade. Now, when it, sort of builds up a little bit more efficiently into that level, you might want to steer clear of that. And there's more nuances when you compare, like if you were to go to a lower time frame. So here, we run up, we hit that level exactly to that level here on this candle and sell all the way down from 40,500 down to 37,000 at the close. And it's a good example of how, price levels are much more responsive when price moves into them impulsively, and they typically offer very quick reactions with low opportunity cost. But let's just mark this level off here on the daily chart and go down onto the lower time frames to see kind of what it looks like in greater detail. So I'll just go down to a 2-hour chart. Again, the time frame itself doesn't really matter all that much. It just, whether it's 1 hour, the 2 hour, or 3 hour. So here we go. So here we have that daily candle. We see our trade up. Now, that's a much better trade right here, right? Than the when price starts building up into this level. That is a little bit, when price builds this efficiency into a level, that's not a great area to take the trade because, ultimately it ends up getting run through. Let's see more examples of that. So, so essentially, and this is looking at, if you're looking at the left side of your chart, so maybe you are looking for price distinctions over here. So maybe you mark off this level right here, 45,300. And let's see how that plays out on the right side. Again, a lot of time has passed, but you can see how, price comes up to that level. Again, it doesn't offer a top on the market, but it does run into the level, sell off, give you a tradable reaction. You can trade that, use it to manage risk and to take profit out of the market. So price hits that historical level, sells off, maybe you take profit, maybe you at that point you don't know if price is going to go lower or what, but you do know that it gave you a reaction and you can take profit there, and you can also set a stop there. And price comes up. When it does come over, trades down into that level, offers a reaction to the other direction, sells down. But ultimately, let's see if this one offers a reaction. So in order to do this, we need to constantly reference the left-hand side of the chart. So here you go. Here's a price distinction right here. So go down to the 2-hour chart, scroll all the way back. We're at this level right here. So you saw that level on the daily. It was this low right here. It ran up here. Essentially a clean break on the daily. And, price moved up pretty inefficiently into that level relative to the previous price action, that was retracing, moving, retracing, moving. But here you get a run up into that level, very low liquidity in a very inefficient way, and then you get a major reaction. We can also point that out here. Let's see. So you have this swing within the macro swing, And we've talked about this before, but essentially you have your volatility contraction right there, point of origin. Price moves aggressively away from it, and then price moves, very, very, very impulsively into this level. If you were trading that day, you know that this candle took place in a couple minutes. So let's go down to the 2 hour. Yeah, and you can see here. And again, the important caveat to add to this is that you're trading you're trading a higher time frame level, right? So you have this level identified on the daily chart. It's the daily point of origin. It's not a 2 hour level, but you're using the 2 hour level to understand or using the 2 hour chart to understand the inefficiency and the impulsive nature of the move, which is contrary to the way a lot of people think when they interact with the market, right? They see a move like this and they see this as strength, right? Whereas a more advanced trader is going to say, well, that's not strength. This is impulsive and weak, and it's if it runs into a higher time frame level, it's going to offer a reaction. And another distinction that this makes between other less informed traders is they're going to assign value to that it doesn't have, right? So just because a trader identifies this as being impulsive and weak and trading into a high time frame level, maybe they take a long here, get an instant reaction. Well, they're going to know that they're not going to demand that this be a bottom in the market. They're going to take the instant reward that the market gives them and start managing equity on the account up here. Um, Again, this kind of ties into not looking for tops or bottoms in the market, just trading volatility without uh, implying rigid beliefs on the market. So tying back into what we were talking about earlier, anytime you see efficient movement up into your level, right? So when you see a buildup, maybe you wanted to trade this level right here. This would be a price distinction. It didn't quite reach your level, but you see price moving very efficiently underneath this level, right? Grabbing liquidity from beneath it, and so maybe that's not the level you want to trade, right? Because it's moving efficiently right up to your level, right? It's not the best setup. But now here, price moves, very efficiently, and in this case, actually overshoots this level, but um, moves up into actually this price distinction up here. Sorry, right, right here. So that would have been tradable, but this is a good trade because of the impulsive nature of the move, right? That I'm just trying to reframe some of the way that somebody might look for an entry, and contextualize it within this the context of inefficiency and efficient price movement. Yeah, again, right here, you see on this break up, you see very efficient movement, right? As you have this consolidating range essentially where price is getting pushed into this narrow band right at the end here. And it actually doesn't break it on a volatile fashion. A lot of times Bitcoin will just, when it gets pushed into the end of a range, it'll just burst to one end or the other, but you actually don't see that here. You see a very efficient movement up. And so as this, efficient movement up is approaching your, price distinction that maybe you identified and maybe you've been waiting for a couple days for price to reach it, um, you know, this is a much more tradable endeavor, right? When price really takes that final leg up, goes really, really parabolic. Um, Again, it's a little different than the way most people think about trading, but it's a way to you know uh, dynamically interact with the market in a nuanced way, and it's also you may wait a long period of time for price to hit a distinction that you've identified as a great trade, and ultimately the way that price approaches it kind of diminishes the edge that's there. And sometimes that happens, and sometimes the trade you've been patiently waiting for ends up not being as good of a trade as you thought it would be when price approached there. And then but then on the flip side, always what happens in those situations is new opportunities will present themselves that you couldn't have predicted. There's just no way to predict, but because you made it yourself available for those opportunities, that you're in a place where you can take that trade. Anyway, I hope you guys like this video. Please make sure to subscribe to the channel. I'll catch you guys in the next one.